Happy Wednesday, guys. Welcome to another week of the Educated Home Buyer Live with Josh and myself here to answer your mortgage and real estate related questions, update you on the economy, and have some fun while doing it. We appreciate you being here week after week. It's December, which is absolutely crazy, Josh. We've been doing this, 40 something times this year?
40 years.
It feels like 40 years, but doing it a lot this year. And we're almost to the end of the year. So we want to update you, keep you in the loop so that you can make informed decisions as we move into 2026. So with that, Mr. Lewis, anything you want to add?
Happy Thanksgiving.
Welcoming people here.
We missed you guys while we were resting and relaxating. Were you commuting?
Relaxating?
Yes. Were you commuting last week to your ski chalet?
At this time in Wednesday, no, I was there. We left at 4 a.m., Mr. Lewis. We were a long day of snowboarding at this point and ready for a nap and perhaps a drink at this time of the day.
The Lewis family doesn't do 4 a.m.s. We just don't. It's against the rules.
That's fair. We did it, and it all worked out. We got to the mountain early, got a couple good days of skiing, and had a good time. So it was fun. That every Tuesday prior to Thanksgiving, I always do a client party. This year was no exception, and it was the 11th annual, Josh. 11 years I've been doing that, which is crazy. But actually got to see a couple people that have found us here on the show and see them face to face once again, which is always a good thing, a positive thing to be able to just meet and connect and have a good time and break bread and all that good stuff. So with that, I had a good Thanksgiving. So but these people aren't here to hear about that. They want to hear.
They had a good Thanksgiving too. We all had good Thanksgiving. So let's
you're
bring
here,
them the news.
Yes. So how the show normally works is we start with what's happening out there in the economy, what's driving mortgage rates, what's driving house prices, what's impacting them both, along with how to help you make informed decisions as we move into 2026. And today is, again, no exception to that. We are going to break down what's happening out there in that world, and we're going to start with some charts, and then we'll break into questions. So regardless of whether you're watching us here on YouTube or Instagram, make sure you let us know if you have questions. We'll be sure to answer them. And if you can't stick around, we'll answer the question anyway, and you can go back and watch the replay and have the answer for you. So, Mr. Lewis, we like to start with tonight a little bit different. We're going to talk about the home buying workshop that we're doing next Tuesday. So next Tuesday at 5:30 Pacific Standard Time, we're going to be live, essentially, not here on StreamYard, but through another platform similar to Zoom, where we're basically teaching you how to buy a home in 2026. We're going to go over the entire process from the mortgage and real estate side to give you the guidance, the expertise that you need to make, again, informed decisions so that you can buy right, borrow smart, and build wealth. There's a link at the bottom of that template, that little image there, theeducatedhomebuyer.com/workshop. And it's actually pinned in the description here on YouTube as well. So you can catch that. Make sure you sign up. We helped 7 different people last year that went through that workshop buy a home in 2027, or we actually helped them buy in 2025. And if you're watching this, you're going to buy.
Maybe they want to move up,
and maybe it'll be 2027. I'm getting ahead of myself. But nevertheless, that information there will guide you in the right direction. So, Josh, a big topic out there at the moment is price declines in the market, and that the market is settling, inventory is adding up in a lot of these markets, and we have people watching from all over the market. So essentially what we talked about in the middle of all the hype was that the markets that appreciated the most were probably the markets that were going to see the biggest flatlining, the biggest declines when the market kind of settled down a little bit. And essentially that's what we're seeing here. But, when you look at that, the blue on that chart is from essentially the start of the pandemic up until the peak, which was basically sometime in 2022, April, May of 2022 is essentially when that peak was. And then after that, the column to the right is essentially what's happened from the top of that peak until now. And so you can see even in a market like Austin that is declined, 20 something percent since 2022 is still up significantly prior to that pandemic. So depending on when you bought, depends on kind of where you sit at the moment. And that's essentially what's happening in a lot of markets out there. But even then, some of these markets where you see the blues and those colors, those are markets that even since that peak in 2022 have continued to appreciate and show demand out there in those localities, if you will.
The other thing, Jeb, that's important to note here is that percentage is not across the board. Every house in Austin didn't drop 26. Some of them might have dropped 35%. Some of them dropped 10%. The best example, we deal with a lot of people out of the Phoenix market. We have a listener to the show here. It's been shopping for the better part of a year and keeps making lowball offers and keeps getting beat out on those because he's concerned, rightfully so, that you can see the market is dipping a little bit there. The issue is kind of what we've talked about a million times is if you're middle of the bell curve, right at that median price point, median or lower, and you want a really nice property, there aren't a lot of those properties. So they are doing better than other homes. And it's not going to match up with the headlines if that's what you're looking for. If you want beautiful turnkey right at median or below, your mileage is not going to be the same here. And you get into issues. We don't have a whole lot of listeners here that are focused on the luxury stuff. Luxury does its own thing. So don't look at these percentages and just think, hey, across the board, that's how homes performed. Some did better, some did worse.
Yeah, no, absolutely. It's all about when you bought, and we continue to push it here on the show. It's all about buying when it's the right time in your life. But essentially, that's the top of that chart. This chart was so long that I actually had to divide it into two different charts so that you could see them. But as you move down that list, again, you see a lot more states that have, or markets rather, that have not only appreciated significantly prior to the peak in 2022, but since that peak. Markets continue to appreciate. And it's, again, all comes back to supply and demand, which is what we're going to talk about here in just a minute. Josh, this is just another chart showing you the markets. I think this is the top 50 metros or so, maybe top 300 metros. I can't actually read that chart because it's so small here on my small teleprompter screen, Josh. I need the Excel. Can you read it?
Among the top 300, 102 markets, it looks like, saw prices dip. And this is the biggest dips among those.
Yeah. So anyway, as we've discussed, a lot of those markets are in the markets that saw the most appreciation. The majority of those being in Florida, Texas, Louisiana. You got some up in Boise and some of those markets. Again, it's a lot of places where people were fleeing during the pandemic to get away from the craziness out there in the market. But with that, inventory has continued to decline, as we would have expected for this time of year. As we move closer to the end of the year, we're going to see those numbers continue to come down. This year, I think, I can't remember what this past week was number-wise, but we saw 15,000, 20,000 homes less than the same time last week. So decline there. We're now 15.6, 15.7% above where we were this time last year. And it looks like we're going to merge pretty close to 2019 here in just, probably within the next week or two. But we should continue to see less and less inventory as we move throughout the remainder of the year. And that's completely normal. Nothing to concern yourself with. It's just seasonality and getting back to a more normal market. We always like to look at Orange County and Huntington Beach. Orange County saw a 3.36% decline week over week, now sitting at 3,628 homes. And when I say homes, I'm talking townhomes, condos, single-family homes, luxury properties on leased land, properties in senior communities. And we're a county of 3.3 million people. So these numbers are really, really small when you start to look at them. They're quite a bit higher than we were last year, but not by a lot as we move towards the end of the year and see that inventory come off. Huntington Beach sitting at 228 properties, which again, we're basically dropping below, where what we saw last year for this time, and should continue to see those numbers move lower as we get closer to New Year's and even partly into January as we see that inventory decline. But 228 properties on the market. This is just a chart from Calculated Risk showing all of the markets, and well, not all of the markets, the markets with the biggest supply of inventory across the United States. You can see kind of Miami leading that list there, 7.7 months. We talked about it many times, Josh. They've always kind of said 6 months of inventory is where that threshold is, where it becomes a buyer's market. No longer really the case, just because of how things are changing and moving or what have you. But what I would say, if you're between 3-4 months of inventory at this point, you're probably in a more balanced market where sellers and buyers kind of have an equal advantage, if you will. If you're under 3 months, still clearly a seller's market, but your mileage will vary by property and by, price point. all that good stuff, the stuff that we continually talk about. Pending home sales, again, moving down as we would have expected. Not going to go over that. The 10-year, the spread between the 10-year and the 30-year actually ticked up a little bit, Josh. But interest rates are more or less moving sideways, which we're going to be talking about here at the end of these slides. But let's talk about what's happening in consumer confidence, Josh, because there's a couple of things that does impact the bond market out there outside of just your traditional things like inflation and jobs. Retail sales is one of those, being what's happening with confidence out there in the overall market.
Yeah, I wanted to show this one because you see the big dip there right at the beginning of COVID. Everyone's panicked. None of us knew what was going on. And so rightfully so, everyone's confidence dipped. And then it trended sideways for the better part of a year. And by early 2021, stimulus checks were hitting. Everyone was like, oh, hey, this is great. And went back up, but not quite as high as it was pre-COVID. But since then, we've had this slow, steady decline. And that's somewhat interesting when you look at the underlying numbers. We're basically doing well in terms of the economy. So just mixed signals. And we're going to look at a couple of other things in here, Jeb, that tell us that we're seeing some mixed signals. Some of those mixed signals here, you've probably heard this, people talking about a K-shaped economy. I don't know why they put this here in gray, but you can see the K in gray, barely. But the blue line shows that the S&P 500 has been basically straight line up, a couple of minor corrections, but straight line up since the dip right at the beginning of COVID. But consumer confidence there, the Michigan Consumer Sentiments, different survey than the last one we're looking at, has been on the decline since the beginning of COVID, pretty much. So doesn't make sense, because usually what you get is wealth effects. People have money in the stock market goes up, they feel better, and we're not seeing that. So is it politics? Is it whatever? Don't know, but we're definitely seeing something different than we have in the past. So in terms of interest rates and the economy and projecting what comes next, the big ones we look at are jobs and then inflation. So the first look, we got jobs in the form of ADP today, Jeb, and I didn't write the number down. I believe it was 13,005. Was it 13,005?
No, it was minus 32,000, and I think they were expecting a positive 10. Something along those lines.
It was bigger than I thought. I knew it was negative, but you can look here. We went from most months 130 to 180 to a little bit of chop here. You know, back in July we had a big month, but this has all been under 50,000 with 1, 2, 3, 4 negative monthly reads here in the last 6 months. So the jobs market is definitely slowing. This chart is the one that we laughed at a couple weeks ago. This is a brand new data series from ADP. So give it another 2-3 months. This is going to be helpful, but they are doing a weekly number. And we had the very first week they came out with it, the figure was positive, and we've seen 3 reads here that are negative since that time. So this will be a much more useful chart as we get more of it, but it's a faster, more real-time look. That's a 4-week moving average of what their data is. Jeb, on Friday, we get our first look really at inflation since before the lockdown, the government shutdown, and it's PCE. So that data is from September. So very, very out of date, but you can see the projections there are 0.22 on the core, 0.27 on the headline. That's not good, because the way this works is they take the last 12 monthly readings, add them up, and that tells us where they see inflation. So if every month was here at 0.25 or just above or below, you're at 3% inflation. It's not horrific, but it's not what anyone wants to see, especially after a few years of elevated inflation. So we're going to have this number falling off at 0.20. And the guess is it's going to get replaced by a 0.22. If it comes in hotter at all, you're going to see a higher headline number. The markets are good at looking at this and these base year effects of seeing what's falling off, so they're not going to be surprised by that. The only thing they would be surprised, but it would be that number comes in higher or lower on the month over month than is expected. But bottom line is we're not seeing the improvement in inflation that we would need to really push interest rates appreciably lower. So this read we've had throughout the lockdown as good as they can with the data. And this peaked up almost like 2.7 about 6 weeks ago, Jeb, and we're down to 2.50. It looks like it was a little lower in the last week. It's a noisy data series, but if you draw a line in there, the trend is definitely still up. It would be nice to see it start trending down.
Well, let's talk about what Trueflation is, Josh, because we have some people watching on Instagram here that probably haven't tuned into us here on YouTube before. And just talk about the difference between Trueflation and the actual inflation numbers that come out, say, monthly.
Trueflation is a nowcast of the CPI index that will be coming further down the line. And it has, what is it, like a 93, 94% correlation over time to CPI, but it's a nowcast. They're just looking and compiling the data much faster. So you're seeing numbers, and we just looked, and if we're at 0.25 on monthly CPI or PCE, and we were there for 12 months, we're at about 3%. And most of those numbers are up. And here we can actually look at that on this chart, because this tells us what the 12-month they're expecting for September. We're going to be at 2.8, 2.79 on the headline and 2.85. So when we're seeing these numbers at 2.5, that would tell us 0.2 most months, a couple 0.3s mixed in there. So the real-time look here that Trueflation gives us says it's not as bad as what the more recent monthly readings are. But until you see this trend sort of the increase start slowing down, I don't think anyone's going to breathe super easy. Threw this one in here just to give us some context, Jeb. This is global inflation rates. The U.S., they're roughly at 3%, depending on which read that we use. And that is towards the higher end globally. So you see the little red box there. That tells you it's higher, but at least we're not Argentina at 31% or Turkey at 33%, Jeb.
Good thing we're not Argentina for a couple of reasons, but inflation being one of them.
We're doing way better than them in terms of inflation. And one of the things to remember, and I don't know if I left it in or pulled it out, I did leave it in. There's a correlation here between inflation and growth. Growth is generally measured by GDP. Atlanta Fed puts out their nowcast of estimated GDP, and we're getting here late in the quarter, and they're up over 4%. The consensus, blue chip consensus, is approaching 3%. So it tells us we're probably going to see somewhere between 3 and 4% GDP, which does correlate with a little bit higher inflation.
And what's crazy is second quarter, Josh, we were negative GDP.
You had the big one where the inventory pull forward, and then you had the super negative. So if you look at it, if you average Q1 and Q2 and then look at 3 and 4, they're pretty consistent. You just had weird manipulations with inventories front running the tariffs.
All right, good stuff. What are we looking at? Oh, so now we got the possibility of a Fed cut coming next Wednesday, Mr. Lewis.
I want to say, Jeb, when we were here last on air 2 weeks ago, was this number at like 34%? So
I think, yeah, but it popped back
shortly.
Up
shortly after that is when it shot up. But this number was over 90% after the last Fed meeting, all the way down into the low 30s, may have even got lower than that. And now we're back to 89%. We are very confident that we're getting a cut next Tuesday. And that's really related to that jobs data, because we just showed inflation is hotter than what the Fed would like. It's hotter what consumers would like. So why are we stimulating? We're not stimulating. We're taking our foot off the brake a little bit more than where it was before. What does that mean for mortgage rates? That's probably what you guys actually really care about. We've got 30-year fixed about 6.25, 0 points. And if we're looking at FHA and VA, about 5.875. So that sounds about right. Again, well-qualified borrowers, very high credit scores, bigger down payments are going to do a little bit better than that, especially on the government stuff. We're going to get our borrowers a little bit better than that. But that's what Mortgage News Daily is reporting today, and it's pretty accurate.
All right. Do we have another one after that, Josh? Is that it?
I put it out of order, Jeb. I'm all discombobulated. There's the technicals. Really, all you want to see here, we are technically within that green down channel where rates are moving lower. But if we go back to September, we can see we're just chopping sideways, and we're right in the middle of that range. So if anything, a slight downtrend, but really just sideways right now.
All right, good stuff. So with that, guys, now is a really good time to start putting your questions in to get them answered. We do have some questions here a question here on Instagram. As I said a couple weeks ago, we started going to Instagram as well, just because StreamYard now allows us to do it in a format that's actually looks somewhat decent, if you will, as opposed to how it looked prior. It still needs some improvement, especially when putting charts in there. But there's a good question here, Josh, and one that I don't know that we've had before, and it's something I think we definitely need to address. And the question is, if a person is having trouble to afford their mortgage, say they're house poor, should this person sell and live with their parents or something else, or should they keep on track and take another job? Josh, so if you were in a position, house poor, what would be your approach at this time in the market?
Don't make decisions off of a temporary situation. So if you feel like this is a temporary dip, something happened, and I'm going to be out of this situation in 3 to 6 months, large transaction costs getting out of your home. So that money you're never going to get back. So even if you, let's say it's a $500,000 house, if it's 6% to get out, that's $30,000 of selling costs. So even if you walk away and you make some money because you bought that chart that Jeb showed early in COVID and things ran up and you can pocket some money, that gives you relief in the short run, but over the long run may not be the best thing for you. Now, if something happened, I became disabled and I used to be a plumber and I made $125,000 a year and I can't do that anymore. I don't know when I'm ever going to have $125,000 income. Now we need to look at more permanent solutions to a permanent issue. I would also weigh, what is your market doing? If you're in one of those markets where it's dipping, where you've seen your prices dip and you're worried you're going to lose some of your equity if you don't sell the property, those are things that I would start weighing in. It's not an easy, it's not a do this or do that. You really have to weigh your situation. But what else would you factor in?
I mean, I don't know. I think you covered it all. I think the first response was probably the best response is don't make irrational decisions based on things that are temporary. And you didn't say irrational, but it's some similar thing. Just, weigh everything, pros and cons, and figure out what the long-term goal is, and see if you can come out of it. But if you're truly struggling to a point where you can't make the payment, and the second job is only going to get your head above water where you're barely breathing, I don't think that's a solution. I think you need to be able to be to a point where you're no longer house poor. And I don't think interest rates are going to adjust quick enough for you to be able to refinance and, actually take advantage of a significant difference that would allow that. So I don't know. I would say talk to a professional in your market, see what it looks like at actually selling it, and then look at the numbers, a seller net sheet, kind of back your way into it and see if it makes sense for you. In some cases it might, in others it might not. It just, it's too tough to tell. Your other solution, quite frankly, is maybe call your lender. These are difficult conversations, but tell them, hey, listen, this is where I'm at. I'm having a difficult time because of this. And they could provide you some sort of relief, some sort of modification to your loan. I don't know that they're doing a lot of those at the moment, but I do expect if the market moves sideways, settles in some of these markets, that you're going to see more of that. You have to provide documentation, but it could be worth a call if you want to keep the house. If you don't,
if you want to keep it and it's a temporary situation, that is a perfect call. If you say, hey, I've got something here that I got 3 months, 6 months to get through this situation, that can be a great solution. If it's a permanent problem, it really is just kicking the can further down the road. So be careful with the decision.
He says for a purchase for $479, now we're $600. He's in LA County. So, I mean, you got equity. That's a positive thing. But again, what is your rentals? I mean, if you're going to live with your parents, you're not going to have rent. But those people that sell and then they go rent and they go, crap, now I've got to go rent something. What does that rent look like compared to your housing payment? How much different is it? Because a lot of people have super low rates, and that exchange for one, from one to another isn't the relief that they think they're going to be receiving. In your case, it might be. If you need assistance, Randy, reach out. Happy to have that conversation and guide you as much as I can, so that you can make informed decisions. So anyway, good question coming from Instagram, Josh. Let's see here. Back to YouTube. We got a lot of regular viewers letting us know where they're actually not letting us know where they're watching from. I would like to know where you're watching from. So let me know in the chat where you're watching from. Always good to see those pop up so that I know. But Josh, do you see any questions here? I can't. Give me something.
Well, Willing has an interesting one, and it comes up somewhat often. Is it possible to have a lower appraised value if one day after the report is completed, a great comparable sale down the road sells for a higher value than any other comparable sales used? 100%. Your appraisal, they cannot consider anything after the date of the report. They're not going to revise it. They're not going to go, oh, hey, that just closed. I mean, it would be just sort of a treadmill for the appraiser, always looking to keep up with that. So if it's a purchase, we want to know if there's anything, if we're concerned about the value and we know that anything is on the market and likely to sell. If you're refinancing, you probably don't have a realtor like Jeb in the transaction telling you, hey, we have a comp here that is under contract. Can't reach out to that agent and find out what's likely to happen with that. So you want to do as good a job tracking it as you can. We do some things on this end where we're looking at that, but very, very easy when we're not an expert in your neighborhood to not necessarily know what's going on there. But yeah, comps that close after the inspection, you're not going to be able to use those in your value, as crazy as that sounds.
All right, good stuff. Good question here, Josh. Does private school tuition and or college tuition count towards your debt to income ratio?
Only if you've financed it with loans. It has to show up on your credit report. We do not know. Both private school and childcare. So for you or for your children, it's something that you really need to account for. And what I will say is most of the buyers that we talk to, it's one of the first things they say. They pop up and go, hey, I got 2 kids. We've got them in private school. It's $1,400 a month. So yes, my debt to income ratio on paper looks great, but I got $1,400 that's a non-negotiable to me that needs to get paid every month. So I have to be more conservative in my monthly payments and max DTI.
All right. Not a question, but a comment from a viewer out there. Just says, not a question, just a comment. Just here to say thanks to Josh and the team for the cute Christmas gift we received last week. So Josh, sending out Christmas gifts, are you? It's not even Christmas. It's Thanksgiving.
It's for the Christmas season. So see, your gift is perishable. It's awesome. While you're shoveling the pie in your face, it is a wonderful, wonderful gift.
And yours is not perishable?
The scent of the wreath, the lovely Christmas wreath lasts for 30 to, if you're in somewhere cold, like my mom's in Idaho and it'll be 40 degrees the entire month, that thing will go a couple months. You can use that thing.
So explain, how does one get a wreath?
All you have to do is close a loan with us. Some people want to close a loan every year. They'll just keep refinancing over and over again to get a worse interest rate just to get a free wreath every year.
That's good. I actually got 2 this year. I got one from you and one from my neighbor. So now I have 2.
Does the neighbor know that you already get same neighbor that gave you one the other year?
Yeah,
and
same neighbor.
What's crazy
and the same place.
Company. Yeah, the same company, because they're the best. They are absolutely the best. I have another loan officer at our company. He sends an email out and he goes, "Hey, you guys, I've been doing this for years and people like it." And I go, "Bro, do not try and horn into my territory." And he sent this company. I'm like, "What is this janky company? Who would even order anything from them?"
Yeah, well, let's not say that company out loud.
We won't. I've put them out of my mind already. We should get sponsored by the wreath company that I use. That is number one, the absolute best.
That would be nice. That would be nice. All right, guys, if you have questions, now is a good time to put them in. Let's see here. We got some people watching from Inglewood, from Palm Springs, from Minnesota, from where else we got? Dirty Birdie, Burbank, Dirty Birdie. I like it. Is that our man? Is that Matt? Is that Matt in there?
It doesn't, unless he changed his screen name.
I don't know.
Which is possible.
It's possible. Riverdale. Where the hell is it? Rivendell. I don't know where that is.
Riverdale's from the Archie comics. I was like, I think it doesn't exist except for in that.
Too good. All right. Let's see here. Not a lot of questions coming from Instagram. So what do we got here? Mr. Josh.
Scroll Bandit is claiming to be from, Scroll Bandit. It is Matt. You correctly picked up that was Matt. He did change his screen name, and GMAC followed up that he is in Castaic.
Yeah, I saw that.
Castaic area.
All right. So Josh, let's talk about right now. We're kind of not a lot of questions coming in. What are some of the biggest mistakes you're seeing for home buyers or people because you get a lot of second calls. You get a lot of people that have a loan with someone else. It's close to the finish line. They're having issues. What are the biggest issues you're seeing right now, and how could they have been corrected or avoided to start with?
I love the question. And we have one today that would probably be my best advice. Guy did not know who Jeb and Josh were yesterday. He found the podcast this morning at like 5 a.m. because East Coast time. So he's 8 a.m., 5 a.m. here because I saw when he scheduled on my calendar. And I talked to Roy, and he is a week into a transaction. Still doesn't have his fees estimates. Every time he asks, the guy puts him off. And I'm like, how is this guy having a compliant file? We have 3 days from getting your application and a contract. The address is generally the last thing on the purchase agreement that requires us to get that loan estimate out to you and have a compliant file. But anyways, he and I went back and forth, answered the questions. The terms the guy was telling him were not bad, but never could get anything in writing. And where we left it, and this happens often, the people that call and reach out for a second opinion. They go, I'm going to call. I'm going to go through it one more time. I think that now, I told him I'm talking to someone else, and now he's going to send over the numbers. He or she, sometimes it's a she. Trust your gut. Like, usually those don't ever, it doesn't get back on track. The person who couldn't give you upfront numbers, who couldn't return your phone call, who didn't keep you updated on what's going on, they don't generally change throughout the process. They don't become someone else. So if you get a gut feel that this isn't quite right, it probably isn't quite right.
And I will tell you, Josh, that feeling is not exclusive to shitty loan officers. That feeling can go across all the different professions, if you will. I can't tell you how many times. I mean, you heard me last week talking about the agent on the other end, how unresponsive, the communication sucked, just everything, and it didn't get any better. It only got worse, to the point where then they ended up calling me and telling me that the house is no longer even for sale and just kind of disappeared. So it's a thing. And so if you're out there trying to find an agent, a mortgage person, if you're not getting responded to, don't expect people to respond to your text at 9 o'clock at night. But if during the day you're not getting responded to, not getting feedback, even if it's not exactly what you need at the moment, hey, I'm getting it for you, I'll be, that sort of thing. Communication's key, guys. I tell you, if it sucks in the beginning, it's only going to get worse as you go through that full transaction. So, good piece there, Josh. So we got some questions coming in here. One regarding appraisers, Josh. Are they required to measure the square footage? My assumption is yes. I mean, all appraisers I know measure the square footage, but I don't know if, I'm assuming it's required because they need it as part of the analysis there. But what goes into that?
You can't trust public records.
Sure.
There could be an addition. Something could have been recorded incorrectly to begin with the assessor's office. So they do have to take measurements. They have to provide a sketch with the appraisal showing those measurements so that someone else could go back and check their work after the fact if there were an issue or on a review. So yeah, 100%. They're not allowed to just take the number. And even we get something, you guys have all heard of an appraisal waiver. Well, now there's an in-between thing that's called property data review. And an unlicensed person goes out, and all the unlicensed person does is take pictures to verify the condition and take the measurements to verify the size. So the measurements are a very important part of an appraisal, and you're not ever really going to get around that unless you have a drive-by appraisal or an automated valuation where they're just pulling the online.
Yeah, I guess it's kind of silly that I even said that, because then I started thinking, like, what is an appraiser looking at? Appraiser's looking at size of the house, the square footage, the lot size, which they're not measuring the lot size. They're essentially taking that from public record. But bedrooms, bathrooms, condition. I mean, that's really what they're looking at. And then they're comparing it to other properties, and that's how they determine what a home is worth. So they are absolutely getting the square footage there when it comes to the property itself. The garage is typically not something that they measure or worry about when it comes to the actual comps of the home, at least here locally.
Well, they're going to look at it. If you have a 3-car garage versus a 2 versus a 1, I mean, all twos,
they're going to look at the garage.
They don't care if you have a big 2 versus a small 2, but they're looking at how many garage stalls.
Exactly. Rates, Josh. Fed cut potentially coming next week. We talked about it at the beginning of the show. We saw the probability. It's in the 80% range, 80, maybe even higher. It was 80-ish percent of a Fed cut. Do you think with that cut rates adjust, or is it built into the market already?
The market usually front runs a Fed cut, right? They don't wait around. It's buy the rumor, sell the fact. We're getting data. We think they're going to do this. Let's move the market. Now they do it, and it'll give a little bit of it back. The thing that'll be interesting, where I wouldn't want to wager too heavily one way or the other, is we're coming off the shutdown, the government shutdown. So we're way lacking in data over the last 60 days. And then we're right here on the heels of the holidays. So even getting caught up on some of that data, it feels weird to me after having the shortened week last week of really getting a feel for what's going on in the market. So anything could happen. I would generally expect that rates will keep trending marginally down until the Fed meeting. I wouldn't expect a big spike up after that. The market is really going to start turning to get the data back flowing and tell us, is inflation moderating at all? Is the jobs market kind of weak or really weak, and that'll tell us what happens next for interest rates.
All right. Another question coming in from Instagram says, I see a lot of posts advising people to try to assume a seller's loan, but I never see them get approved for that. Do you see any of that on your end? So ironically, the first loan assumption that I've had as a listing agent happened about 2 weeks ago. And it was a nightmare. It was a nightmare in the sense that it just took forever. Close to 120 days, over 100 days for the loan assumption. Carrington was the loan servicer. It's a process. But the problem with loan assumptions in general, and what most people don't understand, is that when you assume a loan, you have to pay the difference between the balance of the owner's, the seller's mortgage, and what that home is worth in most cases. Most lenders don't allow second mortgages, and when they do, they require even then a large down payment. And so in the case of the property that I was selling, the balance was like 550,000 or so, and the property was selling for $1 million. And so that buyer had to bring in $450,000 in order to assume that mortgage. Fortunately, they were able to do it. Now, that's part of the reason that this was a nightmare, is because it was a really great opportunity for a lot of buyers out there. It was a VA loan at 2.75%. And there were so many people that wanted to do it, but it just fell out of escrow multiple times because people either couldn't do it for one reason or another. Or in this case, we ended up having there was a death on the property that wasn't disclosed up front. And so that became an issue. So there were just multiple things. So I think if you can assume a loan and it's a property you absolutely want, you have the money to do the down payment, and you're not putting yourself in a bad position by putting that down payment down for whatever amount that is. It's a fantastic opportunity. Just because you're able to take advantage of rates that you probably won't see again. And if you do, it's going to be a completely different environment. So
two questions.
Yeah.
Buyer was a non-veteran.
Buyer was a non-veteran.
So why was your veteran seller okay with them assuming it?
Because in this case, the veteran had passed away.
Okay, so no one was able to use that entitlement again, because what happens is if a non-veteran assumes a VA loan, that veteran doesn't get their entitlement restored, so they can't go on and buy another home. So that makes perfect sense as to why they would do it on that. And then the second question, Jeb, how many years were they into that loan?
I think because the loan during the pandemic was modified by the servicer at that time. There were 26 years remaining on it. They bought the house in 2016, and the loan was modified in the pandemic at 2.75%. So I think there was 4 years off of it. So they assumed a 26-year loan at $540 something thousand. So it ended up being a really good deal for them.
A real good deal.
Yeah. So it does happen. It's just not as sexy as Instagram and everybody wants to make it believe. Like, hey, let's just go out and assume a loan. It's a lot more difficult than that in most cases. Another question here, Josh. What happens if you sell your house for less than the assessed value for tax purposes? Are you out of luck? So the tax value has nothing to do with anything.
Nothing to do with anything.
And I think a lot of people don't understand that. They see what the county has assessed their taxes at, or the value of their home at, and think that that's what their home is worth in some cases, and use that number for whatever reason. The reality is the market doesn't care. The IRS, nobody cares what the county has assessed your value at. The only thing that plays in on is your property taxes. That's it. So if you sell your property for less than the assessed value, nothing happens. You're not out of luck. There shouldn't be anything to pay there. Now, if you sell it for less than the balance on the mortgage, then obviously there's an issue there, and you have to that's a short sell, and you have to get it approved, and so on and so forth. But that's a whole different conversation. So hopefully that answers your question there. Another one from Instagram there, Josh. Let's see have you been looking at these?
Here's an interesting one.
Yeah.
First time home buyer, closed in November. Found you guys a couple weeks before closing. Says we're awesome. I just wanted to read that we're awesome, Jeb. I'm going to take that home.
I appreciate that.
I'm going to show that to my wife when I get home.
She's probably listening.
There is a question. Why are manufactured homes on land difficult to finance? The answer is they should not be. A manufactured home not on land is what becomes difficult to finance. If you own the land and the manufactured home is permanently affixed to the foundation, and it's not an ancient pre-HUD tag manufactured home, you can do an FHA loan, VA loan, you can do a conventional loan, not a problem whatsoever. Now, if you don't own the land, it's now not real, it's not real estate, it's not real property, it's personal property. So you rent a space, someone else's land, someone else's real property, and you put your personal property on top of it. So there are special companies that finance that. They don't appreciate like real estate because you don't own the real estate. It is a depreciating asset in terms of a trailer that puts a roof over your head. But if you own the land, shouldn't be any problem as long as the home is permanently affixed to the foundation.
All right, good stuff there. Now's a good time to put your questions in if you have them. There's not a lot at the moment. Josh, this is where I'm going to take a second here just to do a quick little advertisement for something that we have coming up. So many of you know, you've heard us talk about this. There's a workshop next Tuesday, December 9th, 5:30 p.m. Pacific Standard Time, approximately 90 minutes, probably shorter, where we go through the entire home buying process. We've done this 2 times before, Josh. It's been a success. Had a handful of people that have gone through this, purchase homes, 7 last year alone. You come away with some incentives and a lot of knowledge in the home buying process, what it actually looks like. If you're interested, it's free. It's free. I mean, what more can you get? Just value, just throwing at you value. But the educatedhomebuyer.com/workshop will get you registered, and you'll get access to replays and all that good stuff and a couple of things to take away. So if you're interested, make sure you check it out. All right. Mr. Lewis, I saw a question come in.
We got one here on screen, and it's
Yep.
quick and easy answer. What is the best situation for an assumable FHA loan from the buyer and the seller? There is no best situation. It's a situation that works. So as Jeb said, what are the problems? The best one would be the one that has the least problems. So
Sure.
if it's one that wasn't heavily appreciated, where there's a big gap between the sale price and the loan amount, makes it much easier from a buyer's perspective to make that happen. From a seller's perspective on an FHA loan, hey, if you want it, great. The difference is, as Jeb saw, just a slow and cumbersome process where there's no lender involved. It's you, the realtor, having to deal directly with the servicer on that loan, and it can be slow and cumbersome. So really, there's not any magic. It's just if it works, it works.
All right, good stuff. And the reason I keep clicking the question off is because on Instagram, it's literally right over my head. So I'm like, it's weird. It's weird. Clearly it's okay. I mean, people don't probably want to stare at my face anyway, which I understand, but it's odd. So with that, Josh, we got a question on here on what's an IRRL? What's an IRRL loan, Josh?
So Bobby asking that question, I'm assuming is a veteran, is why you came across this. So VA loans have a streamlined refinance. It's an interest rate reduction refinance loan, better known as an IRRL. The big benefits there are that you do not have an appraisal. So a value up, value down, doesn't matter. We save the cost and the time of the appraisal. And then there's no income qualification. So you don't have any income anymore. As long as you've been making your payments on time, you're going to be fine. The same option exists with an FHA, also has a streamline, and USDA has a streamline. So all the government loans have that. Fannie and Freddie loans do not have that. If you go to refinance a conventional loan or a jumbo loan or most portfolio loans, you have to have a full appraisal and you have to requalify in terms of income, assets, credit, all that fun stuff.
And honestly, Josh, when you think about it, seeing like I get both sides of it, but the interest rate reduction loan is just, it makes so much more sense. Like, hey, if I've been making my payments on time, even it doesn't matter what's happened to my income. The idea is that if my payment's going to go down from a refinance, cash out, I understand. If it's a cash out refinance, I understand you needing to qualify. But if my payment is just getting better and making it easier for me, why wouldn't that be a streamlined process?
Yeah.
But hey, listen, I don't make the rules, Josh. I try to break them occasionally, but
back in the day when you used to do loans, you remember this, prior to the qualified mortgage guidelines, Fannie and Freddie would approve like 68, 70% debt to income ratios on a rate and term refinance. And people go, that's crazy. That's how we got in trouble. Like, no, we don't get in trouble on rate and term refinances where we're lowering someone's payment and they've proven to make the number one predictor of future payment is past payment history. It's not income, it's not credit score, it's not anything else. If someone has a payment history of making a $2,000 a month payment, guess what they're going to do when their new payment is $1,800?
Sure.
They're going to keep paying it. And especially when we have a chunk of equity in the property, 15, 20, 30, 40% equity, those people are not losing that house. There is no risk to the lender. There's no reason for doing all of the overkill that we do on conventional refinances.
Yeah, but it doesn't exist. So I just soapbox here, just standing on the soapbox, just throwing things out there that I think are silly. Question: how do you know if on a streamline refinance is worth it, Josh? Any additional things to consider? So just in general, let's just take streamline out of it. How do you know if you should refinance? Like when is the time?
In simple terms, the cost of the loan and the monthly savings. So if I'm saving $200 a month and it's $3,500, my break even is 17 months. That's not bad. We would like that time frame to be less than a year, but 1 to 2 years is not terrible. You can generally say, cool, I get cash flow savings immediately. I get long run savings in 10 months, 12 months, 24 months, whatever that number is. If you talk to some idiot in the call center and he says, hey, for $18,000, I can lower your payment $142, send him a turd in a box to his office, because you laugh, because I see this all day, every day. I'm like, really? To save $312, you're willing to pay $20,000 in loan costs? That is insane. So if we're saving $1,400 a month and you want to pay $20,000, okay, we've got that break even just a little more than a year. Okay, I get cash flow savings immediately. I recoup the costs over time. So specific to FHA streamlines, FHA streamlines are my least favorite refinance, other than the conventional refinances that Jeb talked about that can't be done because the property won't appraise or the borrower no longer has enough income to qualify. And the reason for that, the VA IRRRL that Bobby asked about, there are a couple of guidelines. We have to be eligible. We have to be dropping your rate 0.5%. You have to have been in the home for 210 days from the first payment, and you have to recoup the cost of the loan within 36 months. So if some idiot calls you up and says, here's a $25,000 refinance, and the recoup is 70 months, you're not eligible. The VA just won't do it. They had to put those guidelines in place because there were idiots in call centers doing just that to veterans, taking them from a fixed rate, putting them into an adjustable, charging them $15,000, $20,000 to do so. So what the other piece of it, on a VA loan, there's a VA funding fee. On an FHA loan, there's an upfront mortgage insurance premium. What the VA does is when you come back to refinance, they say, cool, you paid that on the way in. We're just going to take 0.5%. Instead of the 2.15 or 1.5 that you paid on the way in, we're going to do 0.5%. The FHA wants to make things as complicated as possible. So they set a maximum loan amount. So rather than saying, as long as you recoup the cost in 36 months, we don't care what you pay for the loan, they say, here's your maximum loan. And it's your principal balance, 30 days of interest, and 1 month of your mortgage insurance. And what that does is it makes it where on a streamline, you are almost always going to bring in cash to close, where veteran borrowers doing an IRRRL oftentimes come in with absolutely nothing. The other thing they do is they give you a prorated refund, aggressively prorated. So at 3 years, you get nothing back, but at 2 years, you only get like 30% back. So you paid 1.75. They give you a refund of a small portion of that and then charge you 1.75 again to ensure the loan they're already insuring. But that is government ingenuity in action.
All right. Question here. Josh says, what do you think would need to happen in order to move the housing market activity higher? Assume you guys were the FHA director. Josh, I want you to assume you're Pulte. But no, I think the answer is really easy. How do you get more activity in the housing market? You lower interest rates. It's proven. In fact, we've seen it even this year when interest rates went down, activity picked back up. So that part of it is easier, but it's not as easy as me just saying move interest rates lower, right? There's obviously a lot of things that impact interest rates, and interest rates impact a lot of other things. So how you move them impacts everything else, and those can have both short and long-term consequences, which is essentially what we're seeing right now. Activity, real estate activity near some of the lowest levels that we've ever seen. While inflation, 3 years ago was at 9% because interest rates were too low. So it's the pendulum, right? It's swinging back and forth. I think 2026, you're going to see it move more towards the middle, and it's going to be a little bit more activity out there in the market. How much more? Hard to say.
To your point, Jeb,
Yep.
a little dip in interest rates makes a big difference in volume. There was a Housing Wire chart that you and I both saw earlier today, and I meant to throw it in the charts at the top of the show, and I didn't. But what it does is just shows the year-over-year difference in purchase application volume. And when you see that, it's significant. So rates are 0.5% lower than they were this time last year. We have a lot more purchase applications. If you zoom out and you look historically, it's still really, really low. So it's moved up a bunch, but still really low. So interest rates are really the only lever that move things in the short run. We shouldn't be dropping interest rates to spur housing demand. This is going to have to correct. This, being the affordability problem, is going to have to correct itself over time through interest rates hopefully moderating as inflation comes down, wages continuing to go up, and home prices staying flat or a small correction over an extended period of time.
All right, good stuff, Josh. Can you please inform the viewers there what a goat looks like versus what a horse looks like? Your shirt is not a horse. That is a goat.
You think Willing thinks it's a horse?
He does. He mentioned it up in the thing, and he thinks that maybe you should have considered being a jockey. He clearly has no idea the size of you. You would crush a horse.
I could be a Clydesdale jockey.
Josh could be a horse.
I could be the jockey for the Budweiser Clydesdales. That's about all I could be a jockey for.
Too funny. But that is a goat. And I believe the shirt has to deal with Goat Hill. Is that a Goat Hill shirt?
That is their fans. They were doing a fundraiser to keep it up.
But let's not go any further. If you know what Goat Hill is, leave us a comment. Let us know. Let us know that you know what Goat Hill is.
If you know, you know.
Yeah, just give us a word, and you'll know. But
it's not a place where jockeys hang out with the deer horses.
It is not. They might hang out there, but that wouldn't be the reason they were there. Okay, let's see here, Mr. Lewis. Moving towards the end of the show, been on 50 minutes. If you got questions, now's a good time to get them answered. I actually have to go to a rugby meeting, Josh. Rugby.
Why don't your kids just stick to a sport? Why do they want to play every goofy arcane sport? I gotta go to roller derby practice.
There's no roller derby, thank God.
Yeah,
but football doesn't go year round. Soccer's the only sport that really goes year round, and so rugby is.
I give it 6 weeks. You're heading at roller derby practice.
That'd be fantastic. Okay, let's see here. Questions. Now's a good time, my people. Put them in. Nothing on Instagram.
I would say if you are on the fence and you are not sure if you want to show up to the workshop that we're doing, click the link. You can not only register there, you can get more information about it, hear what others who've attended, who were able to buy a home, think about that. And I would just encourage you to check it out if you think that you might be interested. And most importantly, some folks it's not the right time for them. And if it's not, share it with friends, coworkers, family, who it may be the right time for.
Good stuff. All right, guys. With that, we'll catch you next week. Make sure you buy right, borrow smart, build wealth. Adios.